Good day, everyone. Welcome to our webinar for August month. I'm going to start in America, as I usually do. On the screen, you'll see the S&P 500. I'll talk about that in a minute. But what has happened in the last month or so is that there's been a shift towards risk off. That started a little while ago, and that, of course, was caused by the Federal Reserve Bank in America raising interest rates aggressively. What has happened is that the euro has weakened to close to parity. It's gone from 81 euro cents to the US dollar in June, and it's now at about 98 cents to the US dollar. So it's nearly at parity. There's been a massive move of money into US assets and away from emerging markets, and obviously also from Europe. This is partly due to the war in Ukraine, but mainly due to the fact that US T-bills, Treasury bills, are regarded as a safe investment. The impact on the rand has been substantial. It's weakened to over 17 rand to the US dollar, and we'll talk about that in a minute. Obviously, that's caused a high local price of petrol and rising inflation. At the last confidential report, which is, you can see it on the chart here, it's on the 6th of July, the S&P 500 was still below this resistance line here at 3,900. These resistance lines or support lines are very important, and you need to pay attention to them. You can see this particular one at 3,900 was established way back in May this year, and when the S&P 500 came down, touched it twice, and then penetrated it over here on the 10th of June. You can then see that it went right down to its low point at 3,666 and came up and bumped its head against that same resistance line. So resistance then became, support became resistance. And you can see it did that again here, and then again, and finally broke through only here on the 19th of July. And since then, obviously, now, once it breaks above that line significantly, it'll come back to that line, and now the line becomes a support line. So whereas it was a resistance line over here where these three red arrows are, over here now, it is a support line. So it came down, found that support, and then bounced off it again. So there's obviously quite a considerable amount of optimism in the US markets, or amongst investors, international investors, about what's happening there. But you will notice that it came close to this next resistance line, which is at about 4170, couldn't reach that level and has fallen back, including what happened last night where it fell back quite heavily, back to 4091. Obviously, one of the things that's been driving this market up and what's caused optimism is the fall in the oil price, which has dropped from about $127 a barrel down to about, just below 100. And that might have been caused by Joe Biden, the President of America's visit to Saudi Arabia. He may have struck a deal with them to keep the price of oil down to around $100 a barrel. That's obviously very good for him, for his ratings back at home, where the petrol price has dropped from about $5 a gallon US to about $4 a gallon US. And also, of course, it's not very nice for Russia. So he's basically killing two birds with one stone, you could say. And of course, Saudi Arabia is in a position to do whatever they want. I mean, they have an enormous reserve of oil. It's estimated that they could continue pumping at the current rate for about 200 years. At the current rate of extraction, and still have reserves. And their cost of extraction is very low, about $20 a barrel. So they have been making an absolute fortune out of this Ukraine war because it's pushed the price of oil up so nicely for them. Okay, so let's just take a look at that Brent crude oil price. I'm just going to have to put a bit more data on the screen when this comes on. Okay, so there we go to a 2-year chart, and I'll pull in even more to just show you where COVID-19 was. Okay, and here you can see the oil price over the last 2 years or so. You can see that it was after COVID, after the bottom here at COVID, where it fell to about $25 a barrel. It's been trending up very, very steadily between channel lines here. The Ukraine war pushed it up through the top channel line briefly. Then it came back again. You can just see the increase in volatility because of the increase in uncertainty. And then Joe Biden's visit is over here. So that has caused, we think that has caused the oil price to drop back inside the channel lines. And it's now oscillating around here at about $100 a barrel. So that's where we are now. Okay, so we think that was caused by Joe Biden's visit. We're not sure. The Biden administration is not confirming that. In our view, though, this drop in the oil price is temporary. It won't sit around these levels for long. We think it will go back up again. And that, of course, will be bad for everybody, except for Russia, of course, and Saudi Arabia. And, of course, you must bear in mind that the American economy is basically teetering on the edge of a recession. Gross domestic product contracted by 1.6% in the first quarter of this year, and then by a further 0.9% in the second quarter. And obviously they've had these two 75 basis point interest rate hikes, and that is going to have an impact. The government is very optimistic. They point to the fact that in the last quarter, the second quarter, the U.S. economy generated about 1 million new jobs. So that's obviously positive. In June alone, in fact, the U.S. economy generated 372,000 new jobs. Unemployment, of course, is at record lows, and private consumption expenditure is rising. But we're not convinced. We believe that America is, in fact, hovering on the edge of a recession. We believe that there is more bad news coming. You have to understand that the Fed funds rate, or what we call in this country the repo rate, is what the Federal Reserve Bank charges to commercial banks. After the 2.75% increases, the Fed funds rate is between 2.25 and 2.5% in America. The commercial banks, of course, add a profit margin, which they call the mismatch factor. It's about 3% for their best clients. So to go from the Fed funds rate of, let's say, 2.5% to the prime overdraft rate, which is what commercial banks would charge to their most creditworthy clients, you have to think about an interest rate of about 5.5%. And then, so people who are putting their money, depositing their money with the bank will not get a huge amount of interest, because the difference between that prime overdraft rate of 5.5% and the current inflation rate of 9.1% is still substantial. The American economy is running with negative interest rates of about 3.5%. Negative interest rates, of course, encourage people to spend, not to save. In order to save, people need to have real rates of interest. In other words, where the interest rate that they can get is above the inflation rate. Otherwise, there's no incentive to save. And of course, if they continue to spend, that will keep inflation high. The futures market is pricing in a Fed funds rate of about 3.4% by early 2023. Still well below the inflation rate, unless inflation is going to turn around and come down. But we are not optimistic about that. You must bear in mind that in the 1980s, Volcker, who was then the chairman of the Reserve Bank of the Fed, pushed interest rates above 20% in order to get inflation under control. And we expect that rates will have to continue rising for quite a while before the U.S. inflation position comes back under control. So we do not expect inflation in America to come down in the short term. Of course, a wild card is the quantitative tightening process. At the moment, the Federal Reserve Bank is taking about $47.5 billion a month US dollars out of the economy, and they plan to increase that to $95 billion in September. So they're sort of mopping up the excess liquidity in the economy, and nobody really knows what the effect of that will be, because we've never had such a substantial quantitative tightening before, so the impact is not really known. We strongly believe, though, that the rising interest rates and the quantitative tightening will push the US economy into a recession. Once the recession takes hold, it will gain its own momentum. The progress of the oil price will, of course, be a key factor. But we don't believe that Saudi Arabia will be willing to drop the price much more than they have already. They're simply making far too much money. On a side note, we had quite an interesting instance of the hypocrisy in American politics at the moment, where Donald Trump is hosting a golf tournament which is sponsored and paid for by Saudi Arabia at his facility in Bedminster in New Jersey. It's worth remembering at this point that 15 out of the 19 hijackers who attacked the World Trade Center in New York on the 11th of September 2001 were Saudi Arabian nationals. So this makes a bit of a nonsense out of Trump's America First campaign slogan. Anyway, that's just an aside about the hypocrisy which exists in American politics at the moment. All right, let's turn our attention to Ukraine. Ukraine is now in the 6th month of its war, and we believe that that war has entered a new third phase. The first phase was when the Russians thought that they could take Kiev, and they were proved wrong. That was the first phase. Then they retreated, and the second phase was when they decided to take the Donbass, and they're still busy with that, basically. Now the third phase is arriving at this stage because the Ukrainians have received the HIMARS rocket system from America. And this is an amazing system. It's lightweight. It can move very quickly. It's quick to load as well. It's got a range of about 70 kilometers, and it's very difficult for the Russians to destroy the HIMARS because they can load and fire and move in a very short space of time, getting out of the way of any return fire. And they've got a long range. They can range up to 70 kilometers. The situation is changing. So far, the Ukrainians have hit about 40 or 50 ammunition dumps, Russian ammunition dumps, and that's really messing with their logistics and slowing down their invasion. We do see that the situation is escalating, though, with both sides using longer and longer range weapons. But we do think also that this war will become more and more difficult for Russia to sustain, and at some point it will be forced to negotiate. A major effect of the war, of course, has been the rise in energy prices and the reduction in supplies. I mean, the European gas supply ahead of the winter now is in peril. The Nord Stream pipeline is down to about 20% of its capacity, and Germany especially will suffer in the coming months because they are heavily dependent on Russian gas. In fact, it could put the German economy into a recession. So that's a little bit on Ukraine. Now I just want to talk a bit about South Africa and the political situation here. Of course, we are all waiting for this November elective conference, ANC elective conference, with the battle within the ANC. The Zuma camp victory in Natal was a great win for them. And they've now got Sihle Zikala in there as the ANC chairperson. ANC Secretary General Paul Mashatile has issued new rules. He says that nobody can run for election in the ANC with impending charges. In other words, if a person has got a charge against them, they've been charged with something, they haven't come to trial yet, there's been no conviction, but if they're in that situation, they can't run for election. And obviously, this doesn't really suit quite a lot of people who have already been charged with crimes in connection with state capture. Cyril Ramaphosa is also at risk here because he hasn't come clean about Phala Phala yet, his problem at the farm there. Despite all these problems, we do think that Cyril Ramaphosa will be re-elected at this elective conference, quite simply because there isn't anyone else of any stature within the ANC who could take that position, we don't believe. The real problem is not going to come there. It's going to come later in 2024 when the ANC has to face a general election. We think that even if Cyril Ramaphosa is still a president of South Africa, the ANC will get well less than 50% in those elections. This means, of course, that they will have to negotiate and compromise with one of the other parties. The most probable candidate for that is the DA, because its policies are the closest to Ramaphosa's, and we think that this could lead to a positive outcome. Right now, however, the political situation in this country is full of uncertainty. And markets, of course, don't like uncertainty. All right, let's look at the economy now. The year began on a strong note with a good recovery from COVID-19. And then, of course, we had the illegal strike at Eskom and the worst load shedding since 2008. The Ukraine war has had a big impact on the oil price and the rand, and that's pushed the petrol price through the roof, 27 rand a litre. Consumers are battling to make ends meet. There has been some temporary relief as the oil price has fallen back to $100 a barrel. We think it's only temporary, however. Food and fuel caused the inflation rate to reach 7.4% in June, well above estimates of economists, and that's caused the Monetary Policy Committee to raise interest rates by 0.75%. This puts more pressure onto mortgage bond holders, and obviously the MPC here is forced to follow America and Europe so as to keep our government bonds attractive to overseas investors. Rising interest rates reduces local consumer and business spending. It's also bad for property prices. The Monetary Policy Committee has been trying to keep inflation at the midpoint of the target range. The target range is between 3 and 6%, but it has been above that midpoint for 14 months straight now. Much of that, of course, has been due to the rising petrol price, which is really outside of South Africa's control. We do not think that the current drop in the petrol price will last. We think that oil will probably continue to rise, offset to some extent by a stronger rand. May retail sales came in with a dismal 0.1% gain and well below economists' estimates of 1.5% growth and far below April's sales growth of 3.4%. Obviously, this is due to load shedding and the rising petrol price. Consumer spending is about 2/3 of gross domestic product, so growth will be under threat now. New vehicle sales in May came in at 41,000, 8% up on May 2021. Quite a surprising number, really, when you're given the state of the South African economy. In the 6 months to June this year, vehicle sales have been up 11.5%, and remember, that's after the temporary closure of the Toyota plant following the floods in Natal. To date, sales are 21% up over last year. Rising interest rates will discourage buyers, though. A big factor now in discussion is this basic income grant. Obviously, it was extended by 1 year at a cost of about 44 billion rand to the fiscus. It's a major issue within the ANC and will impact on the November elective conference. If this income grant becomes permanent, it would require a 2% increase in the VAT rate, the VAT rate, to 17%. But of course, that would be very inflationary. The commodity boom in South Africa is receding. South Africa will not be getting the same kind of surpluses at the fiscus as they have in the past. So we can't afford basically more social spending. That's really what I'm saying. The fuel price rise, the electricity rise, the rising inflation, high unemployment. Many poorer families in this country are close to breaking point, and they obviously need something like this basic income grant. The result of poverty and starvation is more protest action against the leadership of the ANC. At the same time, the civil service unions are engaged in negotiating with the government over their wage increases. They initially asked for 10%, but they've dropped that requirement to 6.5%. The Minister of Finance, Enoch Godongwana, is heading up the negotiations himself at the moment. In the budget, he has allocated 1.8% rise in the government wage bill. And obviously, this is something which the ratings agencies are watching closely. I'll be surprised if we can negotiate a settlement, if Godongwana can negotiate a settlement here without some kind of strike action. That would be impressive if he can. All right, let's turn our attention to the rand now. I'm just going to put the chart on the screen for you. Okay, there's the chart. What we've got here is a rand which is weakened from levels in April of around 14.50 to the US dollar to the current levels around 16 to 17 rand to the US dollar. You can see the impact of rising inflation in America and the shift towards risk off. So what you'll find is that the rand these days moves quite in line with the S&P 500. When the S&P 500 is going up, the rand strengthens. When it's going down, the rand weakens. And obviously that's because at a time when the S&P 500 is rising, people become more optimistic, investors are more optimistic, and they shift from risk off to risk on. And that causes some of that money to find its way into emerging markets, and particularly South African rand. So you can see the bear trend in America had a negative impact on the rand, but the rally that's been taking place on the US stock markets in the last week or so has positively impacted on the rand and brought it right back. You can see here also that the rand seems to have found some kind of support at 17.10 to the dollar and has been strengthening now. But what you should understand is that this looks like the rand is in a perpetual weakening phase, but actually it's not. The rand has been doing remarkably well compared to other international currencies. For example, as I said earlier, the euro has fallen from 81.96 in June 2021 to almost parity with the US dollar. We can just have a quick look at that dollar-euro chart. Where is it? There it is. No, I want actually the dollar-euro. This chart. Okay, the euro-dollar. What you see here is the fall in the euro. This is a 2-year chart. So you can see how the euro a while back was up here at $1.23 used to buy your euro. Today it's just barely above $1, about 101. So you can see the euro has fallen actually very substantially over that period of time. Not all of that is due to the Ukraine situation or to rising interest rates in America, because those are relatively recent developments. What is impressive, though, is that the rand was at 20.74, 20 rand and 74 cents to a euro in August 2021, and it's now at 16.94 to the euro. So the rand has actually strengthened against the euro significantly during this period. And again, some of that is due to the Ukraine war, but the weakness in the euro began earlier than that. In fact, the rand has been one of the strongest currencies in the world. So far from being a sign of bad governance by the ANC, it actually shows how well the ANC has done in the management of the currency. It's easy to get lost in the negativity as a South African, but we are not doing that badly. That's my point. We see the rand as undervalued, and I've said that on a number of occasions, and we see it as continuing to strengthen. All right, just a few points on Eskom. Obviously, the big news this month was President Cyril Ramaphosa's new plan to fix Eskom and the energy situation in this country. The 100-megawatt license limitation has been scrapped. There's more money for planned maintenance, which is going to Eskom. The 6th Independent Power Producers program has been doubled to 5.6 gigabytes. Local content rules have been set aside. All looks very good, actually. It's just a pity that it took an illegal strike at Eskom to bring this on. And that resulted in the worst load shedding. It would have been much better if the ANC could have got on with this a couple of years ago, then we wouldn't have had this problem. Treasury, of course, the South African Treasury is going to take on some of Eskom's debt probably about half of the $400 billion which it owes. That amount will be disclosed in the midterm budget policy statement in October later on this year. I don't think it'll change the ratings because the agencies, international ratings agencies, Fitch and S&P and so on, have already taken the Eskom debt as government debt anyway. So I don't think they'll make much of a story out of that. And of course, Eskom's general manager, Mflatelwa, said that there will be no more building of nuclear or coal-fired power stations by Eskom. Eskom will concentrate on three things: solar, wind, and gas. And he says that the shift away from coal is going to cost 1.2 trillion rand over obviously a period of time. Right now, Eskom has about 46 gigawatts of power generation capability, but only about 60% of that is available on a good day. The economy needs about 32 gigs to function. And of course now Eskom is applying to NERSA, the National Energy Regulator of South Africa, for a 32.7% increase in the price of electricity, which quite frankly we regard as absurd. And our esteemed Minister of Minerals and Energy wants to establish a second Eskom, a second state-owned enterprise to run electricity to compete with Eskom. Quite honestly, we think that that is crazy. Eskom's generation has been falling steadily, so the amount of power that Eskom delivers has been falling. It was down 0.5% in February, 1% in March this year, and 3.6% in April. In our view, Eskom is going out of business. It's happening slowly, but it's definitely happening. All right, let's look at some of the companies out there. Despite the current rally in stock markets of the world, you mustn't forget that the world markets are firmly in a bear trend. It is difficult to pick winners in a bear trend. Good quality stocks can fall, despite the fact that they're profitable and of good quality, simply because the market is falling. But there are still a few winners, and you can look around for those. We've got some ideas here for you. One sector that will benefit from rising interest rates in South Africa is the banking sector. When interest rates go up, banks immediately get more money because interest rates have risen, but they pay less because the money that they're paying out on interest that they pay lags behind the money that they're getting in for rising interest rates. The repo rate is now at 5.5%, and if you add the mismatch factor, it means that altogether the prime overdraft is around 9%. We see that Nedbank and Standard Bank are both on price-earnings ratios, on dividend yields of about 4.4%. And that means that they are good value. So we draw your attention to Nedbank and Standard Bank as being banks which are offering really good value at the moment. But obviously, the entire banking sector is likely to profit from rising interest rates. Okay, last time when I spoke to you, not at the confidential report, but in my article that I published on the 18th of July, about 2 weeks ago, I punted Tesla in America. Now, I know it's not in a South African stock, and you can't buy it on the JSE, but I did suggest that if you opened an Easy Equities account, you could buy some Teslas directly through them. At that time, Tesla was trading for $721.64. Last week on Friday, Tesla closed at $891, and it's gone up since then to over $900. So that's a gain of 23.5% in just 2 weeks. Some of that gain, of course, is due to the rally on Wall Street, and that is linked to the fall in the oil price to around $100 a barrel. But Tesla is continuing to take market share away from its competitors. It's clearly shown the ability to produce disruptive technologies, and it's overturning one of the most entrenched and capital-intensive industries in the world, the motor industry. It has enormous blue sky potential, and we still believe even at $900 it's probably pretty cheap. Anyway, it was a good pick, and I hope some of you took advantage of that. Now I'd like to turn attention to the copper price and Anglo American. Anglo American produced its financials to the 30th of June 2022. And one of the things they reported was that their copper production was down 17%. The chief executive officer is a chap called Duncan Wanblatt, and he said that we are heading into a world shortage of copper, mainly because of the shift towards renewable energy, electric vehicles, batteries, photovoltaics, rising world demand for copper. I'd just like to put a chart on the screen here of the copper price, so you can just have a look and see what I'm talking about. All right. Okay, here you can see, actually I want to put a long-term chart on here. There we go. That's the chart I'm looking for. Okay, so here you can see the attack on the World Trade Center on the 11th of September 2001. Over here is the subprime crisis. There's COVID-19. You can see the general upward trend in the price of copper. And starting here in 2021, copper made a triple top at $10,000, just over $10,000 a ton. Obviously, this is the Ukraine crisis, which initially had a negative effect, but copper is trending back up again, and it's almost at $8,000 a ton again. Anglo-American has a huge copper production at Quellaveco in South America, and that mine produces about 1 million tons of copper per annum. Copper deposits are plentiful throughout the world, but it takes a long time to develop a copper mine properly. Wanblatt says that the world will need at least 12 Quellavecos in order to satisfy demand. Anglo-American remains a very good share to buy if you're interested. It's a diversified mining company and offers investors many ways to profit, including from a rising copper price. Okay, let's turn our attention now to Steinhoff. We haven't really been a great fan of Steinhoff for quite a long time. Just go back, put in more data on the screen here. What we noticed with Steinhoff over here, this is a 10-year chart that you're looking at here. You can see this descending triple top in Steinhoff that occurred in 2016. And then the market fell off, held for a while, and then collapsed. Okay, now I'm going to look at a more current picture. So this is the last year of Steinhoff, and you can see that when it made that triple top back then in 2016, it was 90 Rand a share. This peak here is at 5 Rand 55 cents, 555 cents, and it's fallen off from there. But you can see that there is some kind of a support developing at this level here, around 240 cents. It's bounced that level 4 times, and it looks like it's going to bounce it a 5th time. And that shows significant buying pressure at that level. Steinhoff owns about half of Pepcore, and they produced results for the 6 months to the 31st of March 2022. Headline earnings per share rose by 28.3%. In the 6 months, they opened 144 new stores, so they now have a store base of 5,708. They were impacted by the floods and the civil unrest, and obviously also by COVID, but the company is doing very well. So we believe that Steinhoff might be cheap at these levels. Obviously, it's speculative. They still got very high debt levels, but they have managed to negotiate a settlement with their shareholders over their accounting irregularities. So it's one to look at. Okay, Foschini. Sorry, I've gone the wrong way there. It's the TFG, the Foschini Group. Right. So this is one of our favorite blue chip shares. One of the things we like about Foschini is that it has been able to expand overseas very effectively. You can see here, okay, let's just go to the 6-month chart. There's a bit of a downward trend line on Foschini, and the share has fallen off with the the bear market overseas, also rising interest rates and so forth. But in their latest trading statement for 3 months to the 30th of June, they are talking about an increase of 7.1% in their total turnover. Their Australian operation increased turnover by 15.7%, and their UK operation by a whopping 39.9%. Their online turnover was also up 13.2%, and all of this was despite in South Africa having lost 33,000 hours of trading due to load shedding. We think that the share is cheap at these levels, and it's on a PE of 12 and a dividend yield of 3.3, and we think it's a share that will start to perform in the future. So there you go, that's for Shini. The next share I want to talk about is Impact. This is in the packaging company. It's a packaging share. I just want to put a bit more data on the screen here. Yeah, that's the chart that I want. Now, what you see here is three charts. The top chart is a simple bar graph. The middle chart here is an on-balance volume chart, and the bottom chart is a volume histogram. And what you can see here is the two on-balance volume buy signals that occurred. One in October when the price was 845 cents a share, and then again a second one in December when the price had risen to 1,323 cents a share. Since then, the share has gone up very nicely, and in fact, it's now trading for around 31 rand, 30 rand and 90 cents. So you can see the benefit of following on-balance volume on your system and looking for on-balance volume buy signals, because OBV shows you insider trading. So obviously somebody knew what was going on. You can see these huge spikes in volume that occurred in October and again in December. That is the smart money mopping up shares in the market at cheap levels because they know the share is going to go up for some reason. So anyway, draw your attention to that. The last share I want to talk about today is Curro. Curro is an interesting company. Obviously, it's an education share. They do education up to matric. And this is a company which has had a very interesting history in South Africa. Okay, there's a one-year chart of it. And what is interesting about this share is that back in December 2015, it was trading on a price-earnings ratio of 244. That's almost a record on the JSE, I think. And obviously, when you see a share like that at a price-earnings ratio of 244, the only way it can go is down, and that's exactly what happened. And Curro fell, but nowadays it's now on a much better PE of around 26.21, and you can see here it's broken up through this downward trend line. We think the share is reasonably valued at these levels, and it has significant blue sky potential. To us, it looks like it may be turning. Okay, folks, that's about all I have for you today. I hope that you found something of interest in all that. And don't forget that we will be doing another webinar like this on the first Wednesday of next month in September. So I look forward to talking to you again then, and thank you for listening.